Okay, let's get started. Good morning and welcome to today's Tuesday Markets Outlook webinar. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play. And today I'm going to be giving you my thoughts and analysis on the current market. So before we get started, just our usual disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today, we'll be kicking off with the major equity indices, highlighting some key levels, especially ahead of this week's Fed meeting. So that's a big macro impact this week, and it's really the only major macro impact for the week is the Fed meeting. Now, we do expect rates to stay even after this Fed meeting. However, what investors will be looking at is the forward guidance from the Fed as to where rates could end up going, whether it'll be another interest rate hike before the end of the year, or basically if they think that they have a better control of inflation, just what will happen with interest rates next. So it's very difficult to say what the forward guidance would be, and I don't really think it makes any sense to try to speculate, especially, because markets can't react irrationally initially after that speech by Jerome Powell. So this week is going to be a lighter week in terms of the market observations as well. I'm not really looking at too many new ideas. We have seen some consolidation across the board ahead of this Fed meeting, and I think markets are looking for either breakout or breakdown opportunity, but we will be assessing where those key levels lie if we do get either a breakdown or breakout. From there, moving on to fixed income and commodities, we'll take a look at the sector rotational model as well, highlighting the sectors that are outperforming and underperforming the broader market. We'll take a look at some subsectors of interest that I have for you today, and we'll end today's webinar with some bullish and bearish market observations. So starting off here with the S&P 500 using the SPY ETF. And this is a consolidation that I've been talking about, that ahead of this Fed meeting over the last few weeks, we can see price has definitely respected this 455 area of resistance, 455 to 460 really. But it's also still staying above 443, 444, finding some support at that 55-day exponential moving average. So a lot of consolidation ahead for this Fed meeting. But let's say we get a more dovish response from Jerome Powell. What we could see there is a retest of 455, 460 and a potential breakout opportunity. I think right now markets, after rallying to this major resistance level, as you can see on the weekly time frame, this was a key level even in 2021, early 2022. After rallying to this level more recently, I think markets do need a bit more of a fundamental or macro catalyst to see a breakout and a potential return back to that all-time high territory at around 48. So that's very much contingent on what the Fed says, what their overall outlook is, especially regarding inflation and where they think interest rates could head to next. On the downside, though, let's say we get a more hawkish outlook. The next key levels to be looking at on the downside is 435, previous swing level, previous area of support, but also that we have a bit of a further gap down all the way to 420, which is also the 23.6 level. So those will be the two key areas to the downside that I'm looking at. And to the upside, I'm looking at around 455 to 460. And of course, the longer term target of 480 major resistance. And of course, the all-time high level as well. Right, taking a look at the NASDAQ 100, that is a lot more sensitive to what the Fed says, given the fact that this is primarily composed of technology stocks and growth stocks that have a higher sensitivity to any changes or potential changes when it comes to interest rate policy. Now, with the NASDAQ 100, we are seeing that same level of consolidation, price still managing to stay above its 55-day exponential moving average, but not really heading anywhere. So very choppy price action in the last couple of weeks. We do have the next key level to the upside, 380 to 390, I would say would be the next key area of resistance. And from there, if we do see a breakout from this area, we have the 410 level, which again is all-time high territory. So a very similar outlook in terms of the key levels for the NASDAQ 100, like the S&P 500. in terms of there's one resistance level that's quite close to where price is currently at, but there's also the next resistance level, which is all-time high territory. And again, like the S&P, very much contingent on what happens with this week's Fed meeting. And I do think that when it comes to trading, it may be best to limit the positions for the next day or two, see what happens on Wednesday, and see how markets react to that. Because right now, the price action across the board is a little bit choppy, it's a little bit ambiguous, and it becomes very difficult to assess, even from a technical perspective, where price could head to next. So right now, you just want to focus on the key levels and look at the different scenarios that could happen, either hawkish scenario or dovish scenario, and see where potentially the major indices could rally or decline to. Now, on the downside, we also have some support between, I would say, 355 and 350, this area here, and of course at 340 as well. So a couple of downside levels of support to be looking at for the NASDAQ 100 should we get a more hawkish than expected response from Jerome Powell. All right, IWM, the Russell 2000 ETF. So we're looking at small caps here, and small caps have once again declined back to this level of support between 180 and I would say 182 or so. Price has found support twice already in the last few weeks, and heading back to this level, set to open a little bit higher this morning. The risk reward does favor the upside from current levels, given the fact that this is a major level of support, but given the fact that we also have such a high volatility event in the next couple of days, we could very well see a breakdown from support. And if we do get a breakdown below this 180 level, that opens the door completely for a decline back down to 170, which is also the 50% fib level and a major level of support. So the two key areas that I'm looking at here for the Russell 2000 is 170 and, of course, 188. Apologies for that, just having some technical problems. Yep. Okay. In terms of a potential breakout from 188, assuming we get a more dovish response than the Fed, breakout from 188 would see price potentially rally back towards that 200 area. And even though it's on a fib level, we have seen price now react to this level on multiple occasions, especially on the weekly time frame. We've had three failed retests there, three trend reversals there at that level. And it is proving to be a very major level of resistance, even though the more key area that I'll be looking at always is a fib level at 210. So a breakout from 188 does still open the door to two resistance levels on this rally of 200 and 210. But yeah, so for now, when it comes to small caps, these are the levels to be looking at, but it is at a major level of support. Currently, I do expect it to stay around this area for the next couple of days up until we get more clarity from the Fed. All right, TLT. So TLT, strong bearish trend. It has been for quite some time. We saw a strong breakdown, I should say, below that $100 level, and a very quick decline towards 92, which is a previous swing level as well, and a major level of support. So despite the bearish trend, we saw a pretty big green candle on the weekly time frame. So price is definitely finding support at this area. Even yesterday's price action does show that some buying power at this area, despite price opening a little bit lower this morning. Momentum is recovering from that heavily oversold condition where the 50-period CCI was almost at minus 400. But when it comes to TLT, I do think that given the fact that the overall trend is still bearish, you're looking to sell into these rallies. And to find the ideal selling points, you really are looking at key areas of resistance. So you want to see rallies towards the 97 level. That's the area of resistance, maybe some bearish price action for good risk reward bearish entry point. You also have that $100 level if we do get a breakout above 97, which could provide another selling point as well. So TLT right now not actionable. I think you need to wait for that rally because price is definitely respecting 92 so far. But there are some key good entry points at around 97 and 100 for a bearish play on TLT. Okay, the US dollar. So the US dollar has now for the last 3 days been on a bit of a decline. Nothing major, definitely not a shift in trend just yet. It's not showing enough evidence of a shift in trend, but this bearish price action is happening at or very close to a major resistance level. We have the major level that I'm talking about is 105.50 to 106. And price is pretty much there. It's made an impressive recovery. Momentum isn't actually in an overbought condition, but this rally does seem quite extended. No significant pullbacks, unless maybe you count that one over there. But I do think that we could see some bearish price action, maybe a decline in momentum, given the fact that this is a strong resistance area. But the dollar remains strong, and I wouldn't necessarily bet against the dollar right now. Even if it consolidates below this resistance level, it doesn't necessarily mean it's a bearish setup. We are seeing a lot of underlying strength with the US dollar, but it is just at the major level of resistance that it has to respect. Also, again, given the Fed meeting this week, and I know I'm repeating myself, but that could very well see a potential breakout or a trend reversal. So I think the dollar is right now waiting for what will happen from the Fed. Is it going to be a positive catalyst to see a breakout and move higher? Or is it going to be a bearish catalyst to see a proper trend reversal, and we could see price continue to decline and maybe trade between this large range between 105.50 and let's say 101 or even 99. Right, gold, I should say. Gold is respecting support at 177, breaking above its 55-day EMA, set to open a little bit higher this morning. Obviously, some short-term fuel from the fact that the dollar is declining, and you remember they do have an inverse correlation, the US dollar and gold. Now, I do see some room for potential rally here. We have 182, but the major level of resistance is 184. Price has respected this level of resistance now for quite some time. And I would say that will provide a very good selling point for gold. I don't think we'll get a breakout above 184, unless we see the dollar actually weaken quite significantly. And right now, we're not really seeing that. So a rally towards 184 could very well be on the cards if we see some short-term dollar weakness, or maybe even 182. But overall, the dollar is still strong, and gold is still on a bearish trend. I mean, if you look at the last few months, price has been posting lower highs, lower lows up until 176, which is so far acting as a major level of support, no doubt about that. But we're also seeing capitulation here on the weekly time frame, with price also forming a new lower high confirmed there. So structure remains bearish, but price action remains choppy, and you're looking for these rallies to potentially enter in your shorting positions for gold. Oil. So oil is quite overextended. This is more due to a fundamental reason. We know supply cuts are seeing oil prices shoot up higher, despite the fact that China data is still somewhat concerning, may lead to lower global demand, but the supply cuts right now are outweighing that, and we are seeing price continue to rally higher towards this 95 level. So 95, previous area of support, also turning resistance. And given the fact that price is approaching this level, very overextended, pretty much overbought on the 50-period CCI, we could start to see signs of I don't want to say reversal, but maybe some resistance and some consolidation with price respecting that level. So I don't expect to see an immediate breakout. If anything, we may see some consolidation, and we could have to maybe wait for additional fundamental catalysts or macro catalysts for further direction. But oil definitely, looking very strong, showing a lot of underlying strength, but definitely also is approaching a resistance level. Okay, sector rotation. We have 8 sectors in the improving and leading category and 3 in the lagging and weakening category. I made a mistake there. And that's because staples has rotated just about from the lagging category into the improving category. So we'll focus on energy first. Energy very much showing leadership in the only sector in the leading category, showing good relative strength, moving towards the right against the broader markets. And that, again, is just due to the fact that oil is showing significant momentum, and that has a high correlation to the energy sector. In the weakening category, we have technology, we have discretionary, and we have communications. So all of these are moving towards the lagging category. But again, that could change based on this week. We could see a fundamental shift in the trends here. We could see these more higher growth sectors in communications, discretionary, and technology find some momentum. Depending on what the Fed says. In our defensive sectors, we have utilities still in the improving category, but not really showing a lot of signs of life. Same with staples. And healthcare, on the other hand, actually moving to the right, definitely one of the better performers recently in the improving category, along with financials. Materials losing out on some momentum, and we have industrials, which has completely lost out on some momentum. It was looking like it was rotating into the leading category for a few weeks ago, and now it has lost that momentum and heading straight towards this lagging category. So taking a look at healthcare, this was a sector that I was a bit bullish on last week. We saw price trading at around 133, but since then, we did see an initial breakout above its 21 and 55-day exponential moving averages and an immediate move lower. The one thing I will say, though, is we're seeing this double bounce here from 131. So if price does break below that, that would invalidate the thesis. But for now, the thesis still stands. I am looking for this move higher here. We are seeing an improvement in terms of momentum and relative strength for healthcare. So I do think this move very much still makes sense. But again, if it breaks below 131, that would invalidate this thesis. Let's see how this plays out over the next few weeks. Okay, the solar ETF, TAN, new idea for today. And I am looking at this as a bearish opportunity because of this breakdown below 55. So price, a strong decline, maybe some consolidation there as momentum kind of recovered. And now we have seen a breakdown with a bit of a strong move in momentum to the downside. And this opens the door for a very quick out kind of trade towards that $50 level. So the solar ETF looking quite weak. This consolidation helped it recover from an oversold condition, but the bearish structure still remains. Okay, JP Morgan, bullish trade idea for this week. And the reason I'm looking at JP Morgan is, when you compare it from a fundamental perspective to the other banks, definitely the best in class. It has been outperforming the other banks as well. So when I'm looking at a major bank or a big name in the financial sector as a bullish candidate, JP Morgan is normally the first one that comes to mind. The only thing is we had a significant pullback from 157 all the way down to 144, but that provided an excellent risk reward. So the weekly time frame may provide a much better picture for what I'm saying, because we have resistance at around 146, 147. We saw a nice breakout, and now what's looking like a retest followed by a big green candle last week, and price is still above its 21 and 55-day exponential moving averages. So it does look like it's setting up for another leg higher, with 160 acting as some resistance, but 170 is really the next upside target here for JP Morgan. So two potential take profits at 160 and 170, and a nice risk reward bullish entry point for really the best performing major bank. AMD is another bullish play here. So AMD, part of the semiconductor subsector, very strong name, very big name within the subsector, and definitely has been outperforming its industry or subsector, I should say, for quite some time. But we did see a bit of a pullback from, price reaching 132. It has pulled back to this 100 level. Again, strong psychological level. Previous area of resistance turning support, and even did prove to be support quite recently. So this provides a very good risk reward bullish entry point for a move higher. But given the fact that the overall trend, it's still very choppy, I'd probably be looking at more of a credit spread opportunity as opposed a debit spread. So credit spread allows to profit in neutral price conditions, whereas debit spread, it needs a big move in your favor very quickly. It's not better. One strategy isn't better than the other when it comes to debit and credit spreads. But my overall outlook here is a price respects 100 and stays above 100, as opposed to simply bouncing higher from 100 and rallying all the way back to 132 or something like that. So AMD bullish credit spread idea here. Let's see how this plays out over the next few weeks. staying with the semiconductor industry, but going for a different directional view here, we have Qualcomm. Qualcomm is on a bearish trend, somewhat similar to AMD, but what I'm seeing here is bearish price action at a pretty key level at around 115. Previous area of support. Now this area is turning resistance as well. You also have dynamic resistance with the 55-day exponential moving average. But most importantly, price is rejecting that level on Friday, and that does provide a good risk to reward bearish entry point for Qualcomm and potentially a revisit back down to 102. So even though the overall trend here over the last month or two has been bearish, price hasn't quite reached this 102.50 level yet, which is why I do think there's room for another bearish leg for price to actually reach this major level of support, as you can see in the weekly time frame. Okay, and finally, we have Royal Caribbean. This was a bullish idea from last week. It still hasn't quite panned out in our favor, but it hasn't invalidated the thesis. As you can see, price above 95. It just hasn't bounced higher yet. So there's not much to say on this one because I think we'll just have to wait and see how this develops over the next week. And if it doesn't really, break out above this 98 level in the next week or week and a half, that's when you probably want to get out of this trade for hopefully a break even or slightly less or minimal loss. But if we do get a breakout above 98, we could see a potential move higher towards 104 and potentially 110, that level also. So for Royal Caribbean, still waiting on seeing how this price action develops over the next few days to make a better decision. Okay, and with that, that is all I have for you today. So pretty much of a shorter market outlook. But again, this was simply due to the fact that we have a Fed meeting this week, and there's no point in speculating too much on what can happen. It makes more sense to just simply wait, see how markets react to the news, and digest the news before looking at better opportunities. So with that, again, thank you everyone so much for joining me. And yeah, I hope you all have a great trading week. I will see you tomorrow for a Firstrade educational webinar on calls and puts. And again, also next week, Tuesday, for another Tuesday Market Outlook webinar. Okay, goodbye, everyone.